The energy sector is in focus with tariff threats hanging over Canadian sales of oil and gas to the United States. Let's get more from Stephen Loukas, President and CEO of Alberta-based Obsidian Energy. It's great to see you again, Stephen.
Good to be here.
Now, we don't know, of course, what final shape tariffs on Canadian oil and gas will take. Do you think Trump will go that far, though?
We personally don't believe that he will. You know, he's very much sensitive to gasoline prices and energy costs in the United States, and I think he has an appreciation for the fact that U.S. refiners are configured in a way that they do need Canadian crude. And so by extension, I think that's why you have seen him back off some of the initial fears where he was inclined to tariff Canadian crude at a 25% threshold.
Of course, the guy likes to bob and weave, but he sounds like he had a friendly call with our Prime Minister today as well.
I did see the headlines come across before, kind of coming on, and it's certainly good to see that that both sides are talking.
Just tell us about Obsidian. You did a divestiture not that long ago. That was something like 25% of your portfolio. Why did you do that?
That's correct. So we've entered into an agreement to sell our Pembina Cardium position to In-Play Oil and Gas. That transaction is slated to close during the month of April. Mm-hmm. We took a step back and looked at our portfolio, which has really been very much focused on growing our Peace River position, and made a decision that putting the assets in the hands of In-Play, whom we deem to be an excellent operator, was really the right decision. Mm-hmm. It sets In-Play up for continued consolidation within the Cardiums, should that board so choose to pursue that. It delevers Obsidian's balance sheet and really allows us to focus on our residual position in Peace River. We are going to be a material shareholder in Play. Mm-hmm. Post-close. We'll own approximately 35% of that company, and we'll evaluate our options in regards to kind of what our intentions are with that stake.
Right. So your Q4 production was about 40,000 barrels of oil a day.
That's correct.
This will bring you down to a bit more than this divestiture, a bit more than 30,000 barrels a day this year.
That's correct.
Your biggest single production is in the Willesden Green Formation, almost 15,000 barrels of oil a day. What kind of crude is that? So
that's light oil. That's also within the Cardium play. That's a different area referred to as Willesden Green. We continue to like Willesden Green. It does have a fair amount of associated natural gas as well, and mm-hmm. We are constructive on natural gas prices here over the next couple of years. So it produces light oil. It produces very strong free cash flow, which we'll continue to recycle into both our Peace River growth strategy as well as returns of capital via share buybacks. Mm-hmm. And we've been very happy with the performance out of that unit.
Typically, what kind of discount to WTI do you sell your light oil at?
So, we've budgeted approximately $5, $5 discount on light oil.
That's pretty narrow, actually, compared to heavy oil.
It is certainly much more narrow than heavy oil, and we've been fortunate to see that discount actually narrow inside of our $5 forecasted number. So, we're very much pleased with that.
And then Peace River, you have this cold flow heavy oil. So it's not SAGD, it's not oil sands in any sense, but it's heavy oil.
That's correct. It's not thermal oil. We effectively drill open hole multilaterals, which have become very much in vogue over the last couple of years. Mm-hmm. And so by extension, these wells are not fracked. Ultimately you have much lower recovery factors when compared to thermal, but wells that have been extremely economic and compete very, very well with our light oil portfolio.
So even though you're forced right now to leave quite a lot of oil on the ground, the economics are decent?
That is correct.
It's so weird. I mean, how much would you get out of the ground as a ballpark?
So you typically will get 3 to 5% via primary development in heavy oil and in multilaterals, I should say. You've seen companies, including ourselves, start to commit capital to water flooding or mm-hmm. polymer flooding the play. You've seen you've seen that forecasted recovery rates double, so 6 to 10%, and that would be versus kind of thermal oil, which would very often be 25 to 30% type recovery factors, if not higher.
So it's tough oil to get out of the ground.
It can be, and I think that is really where the rubber meets the road is really mm-hmm. can you find mobile oil.
Can you find mobile oil that you can move?
Exactly.
Yeah. You're not paying a dividend right now. That's not part of the model at this time.
It hasn't been part of the model. You know, we've decided that what was a better use of our cash was to return capital via the share buyback. Our shares have traded at, we believe, to be a material discount to our intrinsic value, and that's really been the focus over the last 18 months or so. Is really grow our heavy oil position, get it to the point where it's self-sustaining and can deliver free cash flow on its own right and return capital via share buybacks.
And the stock has been a bit of an underperformer, down about 23% in the past year versus a decline of about 4% for the oil and gas producers as a group. Why is that, do you think, Steve?
Yeah, I mean, look, ultimately, markets aren't efficient. And it's not uncommon for companies that pursue growth-oriented strategies to underperform while they're in the midst of the growth plan itself and until they start to get to the finish line. And so we've outlined a plan that will have us committed to growth through 2026. And we think as we approach that kind of end of that journey, you will see the shares appreciate materially and reflect the underlying intrinsic value.
Stephen, thank you very much.
Thank you for having me.
Stephen Loukas